Hey guys, Kanal here from Level Traders. Today's video is all about Forex trading. The reason it's slightly different is I've been getting a lot of questions around Forex trading and whether I do Forex. And so I thought I'd put a short video out there covering the basics of Forex trading. This video is for all those Forex traders. I hope you find this useful. Check this one out. So here's what I plan to cover in this video today. I'll kick off with an introduction to Forex trading, what exactly it is and why Forex market exists, including the size of the Forex market. Then I'll go into details of what a currency pair is and provide examples of some of the most common currency pairs. I'll also look at the US dollar index and why that's relevant. I'll then move on to how you read price or a quote of a currency pair, including what the bid and ask is. I'll also explain what pip and lot sizes mean in Forex trading. I'll then follow this up, providing drivers of Forex markets and potential triggers that can move the price of a currency. And finally, I'll use the US dollar as an example to show you how technical analysis can be applied, and I'll provide my levels and thoughts on this. So that's what I plan to cover in today's video. So what is Forex trading? Forex trading is the conversion of one currency into another. For example, converting the euro into dollars. Currencies are usually quoted in pairs, so in this example, it's known as the euro dollar. Some terminology to clarify before we move further. Forex is short for foreign exchange, and you may have also heard it referenced as FX. These terms all mean the same thing. Forex, FX, they all mean the same thing. Now, why would you want to do this? Convert one currency to another. Let's have a look at some examples. So the first scenario or example, you've got an American company and it has a supplier that it needs to pay in euros. So the company needs to buy euros to settle that invoice. Another example, you've got a global company like BMW which reports its earnings in euros, but it receives revenue in currencies other than euros. So it may want to hedge its foreign exchange risk by buying the euro-dollar futures. Hedging is a means to lock in a certain FX rate so that revenue isn't impacted by the movement in the FX rate. It should be noted that companies do not have to convert all of their foreign currency. Large corporate companies usually have treasury departments that manage this for them. Also, Forex markets are open 24/7 from Sunday evening right through to Friday evening. So there's lots of time for movement and volatility. Another example, when you go on holiday, you need to exchange your home currency for the local currency in order to spend money in that foreign country. So that's another reason why you may need to convert. And the final example I have, speculators like hedge funds and individual traders believing they can profit from one currency strengthening or weakening against another. So these are the drivers of why companies, individuals are likely to convert one currency into another. And the Forex market is the largest financial market in the world in terms of trading volume, liquidity, and value. So moving on to currency pairs. A Forex pair is a combination of two currencies that are usually traded against each other. There are many currency pairs, but here are a few popular examples. So we already talked about the euro dollar. Then there's the sterling dollar, the dollar yen, the euro sterling, the Aussie dollar against the US dollar, the New Zealand dollar against the US dollar, and the Canadian dollar against the US dollar. So these are some of the most popular traded currency pairs. As I mentioned in the euro dollar example, you're always buying or selling the first currency whilst doing the opposite for the second currency in the quote. So in this example, the sterling dollar, if I buy sterling dollar at that rate, I'm buying sterling and at the same time selling dollars. The base currency is always on the left-hand side of the currency pair, and the quote is always on the right. The base currency is always equal to 1, and the quote currency is equal to the current quote of the pair, which shows how many of the quote currency it'll cost to buy one of the base. In this example, to buy one sterling, it'll cost me $1.35521. So when you're trading currency, you're always selling one to buy the other. I mentioned in my video at the start the US dollar index. Now, the reason I want to mention that is the US dollar is the world reserve currency, and many financial products and commodities are quoted in US dollars. This makes the US dollar one of the most important currencies in financial markets. And because of that, there's actually a dollar index, which consists of 6 major world currencies, including the euro, the yen, the Canadian dollar, British pound sterling, the Swedish krona, and the Swiss franc. Now you can see from this pie chart, the euro is by far the largest component of the index, making up 57.6% of that index, followed by the yen and the sterling. Let's now break down what you will see as traders when being quoted a price for a currency pair. So you'll see there are 2 prices being quoted for sterling dollar in this example. You'll have what is known as the bid and ask price. Now the bid, left hand side, is the price the Forex trader is willing to sell a currency pair. And the ask is the price a trader is willing to buy the currency pair at. The way I always remember it is you buy high, sell low. So the higher price is always the ask. That's the price you're buying it at. And the bid is the price you are selling it at. That's the price you could get if you held that currency pair. And then what you have is the difference between the two, which is known as the spread. And that spread is effectively the cost of trading Forex. And that's what goes to the broker. Now, Forex brokers don't charge commissions. They simply make money through spreads. The size of the spread is influenced by many factors. Some of these are such as the size of your trade, the demand for the currency, and its volatility. So some of those common currency pairs we looked at, the spreads on those currency pairs will usually be tighter than a currency which is not actively traded. Then if we look closer at this, the difference between the 4th decimal point, so you see the 2 and the 3 that I've highlighted, that is what is known as 1 pip. Now, in addition to this, currencies can be traded in standard sizes known as lots. There are 3 common lot sizes: standard, mini, and micro. Now, standard lot sizes consist of 100,000 units of the currency. So in this example, a standard lot of $1 being the base currency is 100,000 units of that currency is one standard lot. You've got mini lot sizes, which are 10,000 units, and you've got micro lot sizes, which are 1,000 units of the currency. The choice of a lot size has a significant impact on the overall trade's profit or losses. The bigger the lot size, the higher the profits or losses, and vice versa. So all lot sizes is the size of the trade effectively. So now we've covered the 2 factors, pips and lots. Lots being determining the size of the trade, and pips determining the quantity or the size of the P&L gain or loss. The more pips you make, the more profit you make. Now let's have a look at the drivers of the Forex market. So the first one is central banks. A currency supply is controlled by central banks who can announce measures that will have a significant impact on that currency's price. For example, quantitative easing involves injecting money into the economy, and this can cause the price to fall in that currency due to the increased supply. And you've seen that with the US dollar and the US Fed. The second driver is economic factors like inflation, retail sales, PMI data for both services and manufacturing, GDP, unemployment data, consumer confidence. Then there's fiscal policy. For example, the UK budget is widely watched by traders as it can move the pound sterling depending on what the UK Chancellor announces. So there are many factors here, which is why it's different to stocks. It takes a lot to move a currency because there are so many economic factors that can influence it. Then there's market sentiment. So market sentiment, which often reacts to the news, can also play a major role in driving currency prices. Here are a few examples. So you had the Brexit vote in 2016, which saw sterling crash. And then last year, we had the US elections, which saw big movements in the US dollar. These are the type of headlines that can drive sentiment and move currency in a big way. And to finish off, technical analysis. Now this can be applied to Forex just like stocks. Here is an example of the US dollar. This is a weekly chart from February 2019 to November 2021. And you can see here, the euro dollar had been basing at the 115.20 level, which is a back test of the euro dollar breakout from July 2020. However, this week, price broke below that level, which could spell trouble for long positions. If price follows through next week and doesn't reclaim that key 115.20 level, the euro dollar is likely to gradually head towards the next key support level, which is around 111. If this does in fact turn out to be a false break and price recovers back above the 115.20 level, then the next upside targets are likely to be 115.68 followed by 116.32. But watch out next week for that level. That is the key. How we close next week will determine where the euro dollar goes in the coming weeks and months. With that said, I hope you found this video useful and you got a good insight into Forex trading and Forex markets. Remember to hit that subscribe button so you don't miss any future content. And I'll see you at the next one.